Hello, I'm Brian Shaitkin, Senior Economist from the Conference Board, and this is your Economics Watch for May 2018. This month we are focused on pushing the limits, tax cuts, spending, and the outlook for 2018. Some of the questions that we're going to be dealing with to take an early pulse on what the influence of the U.S. Tax Reform Act of 2017 has been on the U.S. economy so far are: will individual tax cuts help reverse weak Q1 consumer spending numbers? Are firms investing more as a result of the new corporate tax provisions? And how has the composition of that investment changed? And are new international tax provisions driving foreign direct investment into the U.S.? And are U.S. firms keeping more supply chain activities at home? A few housekeeping items just before we begin. First of all, participation on this webcast, and we do encourage participation because it creates a more interactive and exciting webcast. Please ask your questions throughout via the chat box at the bottom left of your screen. You can download the presentation using the file download pod that's at the bottom center of your screen. You can view the video or the PowerPoint full screen. Just click 4 arrows at the top right of the screen. Please complete a brief evaluation so that we can learn more about your views on the webcast and how to improve future episodes. And please share this program on demand with colleagues. You can earn CPE credits through a simple procedure. Type your name in an email address in the space provided. As the webcast proceeds, you will get 3 pop-ups. You have to stay on for the entire webcast and click OK when those pop-ups come up. And credit is only available for live participation, not for the on-demand edition. Joining me today, first of all, from Brussels, is Ilaria Maselli, our senior economist from Europe, who will be giving us some critical insight on how exactly European countries and businesses are reacting to the early implementation of this tax plan. Ilaria, thank you for joining us.
Thank you for having me.
And joining me to my right is my esteemed colleague, Senior Vice President and Director of Research for the Committee for Economic Development, and also a veteran of numerous presidential administrations and congressional committees in terms of helping them make sense of previous tax laws and budget matters, and who is currently trying to dig through this current tax law as well and trying to make sense of it as much as possible for our members. That is Joseph Minarik. Thank you, Joe, for joining us.
Thanks, Brian.
So first we have an audience poll question, and that question is, what will be the primary effect of the U.S. tax plan on the global economy? Will it make U.S. companies more competitive relative to the rest of the world? Will it cause foreign countries to also lower rates for businesses? Will it have little effect on growth or global competitiveness? Or is it simply unclear to you and you're still trying to make sense of this tax plan? So we'll wait a minute for the results. So it seems like we have a pretty even division between those who believe that this plan will make U.S. companies more competitive in international competition, and those who aren't clear yet quite what the effects will be. Joe, Ilaria, any initial reactions?
Not really surprising that people would, to some extent, be unsure about what the law is going to do. We're still in the very early stages of implementation, and it is a complex piece of legislation. So we're going to be waiting and watching. We'll try to give people some insights. I think anybody at this point who says he knows for sure probably had his mind made up before the law was enacted in the first place.
And I think that's an important point, because we are trying to take an early assessment of what the impact of the tax plan has been on consumer and business and international activity. But at the same time, the law is only 4.5 months old at this point. So I think it's going to be early days in many cases, as we'll see. Aloria, any thoughts?
Well, I find it a very difficult question to answer. So I'm not surprised that many people said not clear yet, because when I saw the question, and I even had the privilege of seeing the question earlier than many people, I had the feeling it's like when you're on Facebook and you're setting up your profile and you have to say, you're in a relationship, you're married, and then you have this last possibility, which is it's complicated. So I really felt like answering it's complicated. And the closest to that is not clear yet.
No, I think that's very good analysis of the formation of the question. And so that brings us into the next slide in our discussion about the global and European outlook. And Aloria, this month and the last 2 months, really, Europe has really taken center stage in terms of our global outlook. What should we look at when thinking about, before we start thinking about how this tax plan will impact Europe and the global economy, what should we think about how those two things are changing right now?
Well, I'll try to answer your tough questions, but I'll take a slightly longer road. So let me start from the overall outlook and where we are in the business cycle. And if I had to summarize in a tweet the content of this webcast, for me that would be that, well, the business cycle is maturing. It's been a long one, and the global economy is in a rather strong place. So the chances of a downturn, I mean, there is no sign that we might see a downturn around the corner. Well, of course, that is provided that there is no geopolitical tension rising, and there is good potential there. But still, I think we are in a rather safe place for the global economy. So the estimate for this year is that growth will be 3.3% at the global level, which is a little bit higher than the 3.2% that we had last year. Now, of course, if you look at the regions, you see a lot of different things. So as you mentioned, the euro area weakened in the first quarter of 2018, and we expect that to continue into the second quarter of 2018. And there are many reasons behind that, and I will go into that in one of the next slides. But this is in a way some sort of natural moderation that comes after this extraordinary performance of 2017 that we all underestimated. If you look at emerging markets, the situation is still very positive. They are all in an expansionary zone, and we expect growth to be in the range of 4%. In emerging markets, but I think we should not expect further expansion ahead of us. And I think we should also keep in mind that there is a internal change in the dynamic of the economy, such that local consumption, local demand is becoming more important lately. Then in the global outlook, I think an important thing is, of course, global trade, and we have seen global trade recovering a lot during 2017 and still improving a little bit in 2018. So this is also an important piece of information because this recovery is, of course, at risk, and there is a lot of uncertainty around the trade tensions between US and China in particular, and Europe in the middle of this. Then, just to conclude the overall summary for this month, I think we have to mention two good news from the labor market. One is that our recent release of the total economy database showed that labor productivity has been improving. So there was an uptick in 2017, and our estimate is that this will continue and become even stronger in 2018. So I think this is an important piece of information because, especially in Europe, this was particularly strong. And then the other thing is that the global labor markets are tightening, and this you've been writing about this prior for years now in the US, but even in Europe, the unemployment figures have been improving very constantly in the past 3-4 years. And even though the unemployment rate for the euro area is 8.5% in March, which is the latest data we have, if you look in specific countries, you see that the labor market is getting actually really tight, like in Germany, for example, where the unemployment rate is below 4%, and like in the US, we didn't see these numbers for a very long time. So I think this is the overall summary for this month, looking at the global economy.
Thank you, Ilaria. And how can we assess the relative risk of a slowdown between the euro area and some of the other emerging market regions that we cover?
Well, looking at emerging markets, I think it's safe to say for now that we should not expect a moderation too soon, but it's like, what is sure is that we should not expect further expansion. I think that's what we can say for now, also because the dynamic in emerging markets is actually quite different. So since there is this LEI chart, it's worth looking at some specific lines of this chart. So, for example, the red line is China, where you can see that there's been a nice improvement over 2016 and 2017. And an important piece, as I was saying, of this interesting dynamic is that local consumption, so domestic demand, is becoming more and more important for the overall performance of the economy. And this is an important structural change that is happening in the Chinese economy. The outlook for India is a little bit more strange. You can see also that the green line, right, is the green line, is a little bit more bumpy, especially if you compare it to China. And there, the fear is that, on the one hand, actually, there's been a nice improvement in the export of services, for which India is famous. But that is a small percentage of the economy, so I'm not sure it can have a bigger impact on the GDP growth as a whole. But what can have an impact is the increase in oil prices that we've been seeing lately, because that can alter the macroeconomic outlook for India. And then I'll go to Europe. You can see that it's in a way similar to China. So the euro area line is the blue line in this chart, and there's been a constant and very remarkable improvement throughout 2016 and 2017. But if you look at the latest data points, it feels like the economy cannot expand further. It cannot go better than this. And what we've been arguing already for some months, actually, is that we are touching the supply constraints of the economy. So just to give you one number, the maximum utilization of capacity in the manufacturing sector is 85% in Europe, and we are very small percentage point far from there. So we are touching the maximum capacity, and there is a lot of supply constraints in investment, in the structure of the economy, in the labor supply, that really signal that it's difficult to go beyond that. And apart from the supply constraint, and there was an issue in the last at the beginning of 2018 with exports. Now, you know that the European economy is very dependent on the export sector, and which is, our blessing and our curse. So whenever there is a problem at the global level, we are the first. We are the first to perceive that here in Europe. So the export growth was negative in January and February, and this had an impact on GDP, obviously, because that is an important part of the economy. So this, if you look at the latest number of the orders for the manufacturing sector, it shows that this is continuing into April. And so if you combine this information with the supply constraints, it feels like the economy cannot continue on this trend of 2017. So that's why we expect.
No, I mean, it's definite. So unfortunately, it appears that our viewers cannot see this manufacturing PMI chart. But Ilaria, maybe you could describe what the key features of the chart are that members should keep in mind in thinking about the current euro area outlook.
Well, it's a pity that you don't see the chart, because you would really see that if you look at the PMI numbers over 2016 and 2017, the PMI for the manufacturing sector increased a lot. So it went from just a little bit above the 50 line, which is the line that signals an expansion in PMI in the Purchasing Managers Index. So we went from a little bit above 50 to 60 in a year and a half, or 2 years, no, a year and a half actually. And this was concerning the manufacturing PMI, which is the one obviously related to the most competitive part of the economy, the export sector. So it looks like, if you look at the chart over these last 2 years, it really reached a peak in December of last year, and now it has been declining. Now, we should not be too worried because we are still very much in expansionary territory. But as I said, it feels like, the highest we could go was what we saw in the last quarter of 2017, and now the economy is moderating.
So the upshot is that right now, rather than having a synchronous global acceleration, we have synchronized good global growth in most key economies, but no longer can it be termed an acceleration. There's some risk that the euro area may slow down at still just quite a good growth rate, but slow down nonetheless. So that's the environment we're operating in, thinking about the global economy. Now, Joe, you worked on the 1986 Tax Reform Act, and that act contained some international provisions, but those provisions were different from the one in the Tax Cut and Jobs Act. Could you describe some of the key international provisions in terms of the Tax Cut and Jobs Act, and what were some of the key administration objectives behind those provisions?
Well, the way the new tax law was put together is really a combination of ingredients. One thing that the administration in particular emphasized, the Congress as well, was that a tax cut would be advantageous. It's good in terms of politics. It's good in terms of getting the population on board. And for both the household sector and also for the corporate sector, there were significant tax cuts. On the household side, the tax cuts included reductions in rates, certain provisions with respect to closely held companies, which would provide some additional tax relief. But it was the law was constrained by an overall budget maximum cost. And as a result of that, there were some constraints on individual benefits, including deductions and personal exemptions. On the business side, there were, in addition, some fundamental changes. One thing was a significant reduction in the U.S. tax rate. The idea there was to try to make the U.S. a better place to do business, both for U.S. firms and for foreign firms. More investment here in the United States. And of course, there is also the opportunity these days for intangible capital to be moved to a low tax country for the purposes of getting a low tax rate on the income that's attributed to intellectual property. We eliminated the old U.S. worldwide system, so now U.S. firms under many circumstances are not paying tax on foreign earnings, but we have some provisions that were intended to prevent tax avoidance, a so-called GILTI provision, one of the most delicious acronyms in tax policy ever, the Global Intangible Low Tax Income provision. And then, you put all these things together. Again, the theme is making it attractive to do business in the United States, for U.S. firms to invest at home, for foreign firms to invest here. The goal being more investment, more productivity growth as a result, and therefore the intention, the hope, is faster economic growth here in the United States.
So in sum, the international provisions are based on the idea of bringing capital in from abroad, bringing investment in from abroad, and keeping labor, keeping jobs at home. Those are the twin objectives of the international provisions, would you say?
That's the goal. We're observing in its implementation exactly how this is going to play out, and many of the provisions here are extraordinarily complicated.
Now, Ilaria, on the next slide, we've seen in the past instances of countries lowering their corporate tax rate. Could you tell us a bit about what has happened in those cases and what that slide tells us about how other countries may react in terms of setting up corporate tax rates going forward in reaction to the new U.S. tax legislation?
Sure. So I think there are a few interesting things in this chart, which plots on a timeline all the corporate tax rates in 5 countries, in Germany, France, Spain, Italy, and the US. So there are a few interesting messages. The first one, in my view, is that there is a clear trend downward, so to decrease the corporate tax rate. And this trend started in the early 90s, I would say. The chart here, I don't know if you see it, it's big enough on your screen. It starts from the 1980s and 1981 and goes until 2017. So there is a clear trend downward that started in the beginning of the 90s. And the other interesting thing is that together with that, what decreased is also the dispersion between the countries. So if you look at the beginning of the chart, there is a huge distance between Germany and Spain, and all the countries there are really far from each other. But if you look down the chart in more recent times, they're all getting closer around the same rate. So you can really observe that over the past 30 years, there's been a convergence, a downward convergence towards lower level of corporate tax. So going forward, one can expect that this continues. You know, one country does decreases the corporate tax rate, and then the other country has the temptation of doing the same, continuing along this trend. And there's actually research that shows that within the European Union, where this is a super sensitive issue because there is no one single tax rate or tax policy, inside the European Union there is a lot of tax competition, and this tax competition is really strong coming from small countries. So if I would expect those to be the first to be tempted to react to the U.S. tax reform.
So this tax competition would indicate, based on this chart here, Ilaria, that as the U.S. reduces its headline rate, which, as we'll get into later, is only one small aspect of judging corporate exposure to tax rates, from 39% to in some cases 21%, but in practice 25%, just because it includes the 4% for state and local taxes. This would suggest that other European countries may, in response, lower their rates as well. Is that something that we've seen countries thinking about to this point?
Not yet, but I would expect that to happen at some point. Just for information, there was an attempt just before the discussion started in the U.S. on the tax reform of the European Commission to not to agree on a common corporate tax rate in Europe, because we are centuries away from that option in terms of level of integration in Europe, but to at least agree on having a common corporate tax base, so that the corporate tax rate would be calculated on a tax base that is not Ireland or Germany or Italy, but it is the territory of the European Union. So that doesn't exist, and the Commission took out this proposal from the drawer. This is actually an old proposal from many years ago, and they took it out from the drawer just before the U.S. started discussing the tax reform. So I think this corporate tax reform in the U.S. actually killed a little bit this discussion.
Right, because you have this race to the bottom type dynamic, and so now there's sort of a question of whether you're going to see whether there can be any effort to set a universal European corporate tax rate, or if you're going to continue seeing lowering of rates. So this chart here, Aloria, is one way we have of assessing whether that first objective, bringing capital home from Europe and elsewhere, is happening, whether FDI is indeed flowing into the US. And what you can see here is that the green line, the movement of the dollar index, what has since early January actually caused the dollar to weaken somewhat, even though it has strengthened in recent weeks in reaction to a slowdown in euro area growth. What do we think right now about any evidence that capital is indeed flowing into the US in response to the changes in the tax law?
So that's obviously very difficult to assess because we don't have many data points to answer this question. But so just one step back is to look at the theory. So the theory would say that there is a tax cut, and this gives indeed a big incentive, together with the exemption for 5 years on investment in the US. So this gives a big incentive for capital to go into the US, so to invest into the US. So we would expect foreign direct investment to increase, going from all over the world, from Europe, where the magnitude, I mean, the size of this size is really huge, into the US. And this would translate into an appreciation of the dollar. Now, the positive thing is that this is not happening. So we would have expected some movement before January, when there was a discussion and it seemed that the reform was going to happen. And if you look at the green line in this chart, the only movement you see is really in the last 2 weeks. So I'm not even sure this is related in any way to the tax reform. So I don't think there is yet, at least, evidence that there is capital flows going into the US. Now, again, the past research on past tax reforms comes here handy because in 2009 there was a similar reform in the UK, and in the UK they actually moved exactly like in the US this year from a worldwide to a territorial tax system. So this was also a big change. And some people evaluated the results, taking into account, of course, that evaluating the impact of tax reforms is unbelievably difficult for a researcher because you don't have any counterfactual, and there is a lot of things that influence the economy, not only the taxes. You can have a recession, you can have an upturn. So it's very difficult to study this subject. But what the research finds is that it looks like there was a positive impact in the UK, in the sense that indeed more FDI, more investment went into the UK after the reform, but it was a very short-lived benefit, in the sense that it led to some one-off behavior from companies, and it didn't have any long-lasting effect on the economy. It didn't really change the behavior of the firms, except for the moment after the reform itself.
No, absolutely. I mean, you definitely do not see from that reform effort sort of a long-lasting change in behavior. So it'll be interesting to see if the U.S. tax reform experience will be different. We'll learn more about that as time progresses, just because firms will have more time to react to it. One more point I want to make about this chart is the blue line, which, of course, is of great interest in these days, given the U.S. withdrawal from the Iran nuclear deal. You could see that oil prices have been rising in recent weeks and recent months. They hit the highest levels since late in 2014 this morning, which is not shown in this chart, but did indeed happen. And that's an important element of what's happening in stock markets, and also what's happening just in the U.S. economic outlook as a whole, where markets and the economic outlook are still pretty strong, but there are greater risks simply as a result of the fact that oil prices are higher as a result, in part, of greater global demand, but also certain policy actions. And certainly we can see that trade policy and questions about where trade policy is heading and how company supply chains may be impacted by that. That is going to play a role in shaping firm behavior. But overall, we do see as a baseline scenario that growth has the potential to be quite strong, near 3% through the end of 2019. Consumer and business confidence measures remain strong, despite the fact that consumption growth was a bit disappointing in the first quarter. Fiscal measures are going to be supported both in terms of the tax cuts and its effect on businesses and consumers, but also the increase in government spending that we'll talk more about later in this program. There are signs that a tight labor market is also causing consumers to have more spending power in the form of a wage pickup, but that also means higher inflation risks, which could mean more rapid Federal Reserve interest rate tightening as well. And there are a series of uncertainties that could potentially delay investment around trade policy. How are NAFTA negotiations going to be resolved? How will opportunities to trade with China and Europe change as a result of tit-for-tat tariff standoffs? Technology stocks valuations appear safe for now, but those firms are operating in a more uncertain environment, one in which data protection is becoming more important to consumers and where there are dramatic regulatory changes in the form of the general data protection regulation taking place in Europe. We'll have more about that on a webcast window on later this month. And indeed, the economic environment, certainly in Europe, is cooling, and that's going to reduce external demand for U.S. goods. We have a poll question. Actually, I'm sorry. Next, what I want to talk about, I want to have Joe comment on, are what are some of the key individual provisions that could cause changes in consumer spending and consumer behavior in this new tax law?
For most of the population, Brian, people who earn their income through wages, and therefore their taxes are paid with withholding out of their paychecks, we're seeing some increases in after-tax income. So far this year, as you've noted, we have not seen a big kick in the pants for consumer spending. When that is going to happen, if it is going to happen, is a real question. There's some debate as to whether people really noticed an increase in after-tax income. If it happens at the beginning of the year and your employer is giving you a raise, how do you know which is which? How enthusiastic are you when you see a few extra dollars? And in many instances, at the end of the day, the tax liability may not be all that different because of some of the things that taxpayers lose. They lose their individual exemptions, they lose itemized deductions for state and local taxes, and so on. One of the tricky things here, by the way, is withholding may or may not be very accurate. It is within the realm of possibility that the withholding tables may put people in a position where early next year they have to either endure smaller than expected refunds or maybe even write checks. There's some question about how that process of determining withholding deductions actually work through. The process for individuals, as we mentioned, is kind of give and take. Lower rates, but cutbacks on state and local tax deductions, a change in later years in how the tax brackets are indexed, so that's going to have an effect. But put all these individual provisions together, and it's pretty clear that the objective of the law was, for those familiar with the economic jargon, it's really kind of old-fashioned Keynesian economics. The helicopter goes overhead and you drop some cash out. People pick up the money and go to the store and spend it, and that was intended to provide a stimulus for the economy. Is it going to happen? We don't know. And There are all these question marks about the puts and takes in the tax law. There are questions about tax cut provisions that are going to expire if you take the law at face value. So individuals may be somewhat ambivalent about how they're going to react.
So let's see how that helicopter is playing out so far. So as I mentioned, our overall GDP forecast, which can be shown in the blue line in this chart, does still remain quite strong, near 3% growth through the end of 2019. Consumers are still feeling good about the state of the economy, whether that's because of those tax cuts, whether that's because of an unemployment rate that has dropped below 4% for the first time since 2000 is unclear, but our consumer confidence measure shown in the red line, it remains at a very high level. We have seen an easing in the ISM Manufacturing Composite Index, which is a key measure of business confidence. And you have that measure remains at a pretty high level, but has fallen a bit in the last few months, which may explain some of the recent shortfalls that we've seen in terms of capital spending that we'll discuss later. Turning to the question of wage growth, unemployment rates are extraordinarily low right now, so labor markets are quite tight. We present two measures on this chart. First is an average private hourly earnings measure, which has not shown all that much acceleration in recent months. But when you control for the composition of employment in a given industry, in a given occupation, so you assume, for example, that the number of nurses in the healthcare industry will remain the same share of total employment, we do see that the employment cost index, the green line, is showing some signs of acceleration after a long period of relatively disappointing wage growth. And we'll see if that translation process continues. You can see that wage growth figures are still much lower than they were during previous expansions. And that will be an interesting test to see whether U.S. consumers get more money to spend in addition to whatever benefits they're experiencing from those tax cuts. In terms of consumer spending, it was weaker during the first quarter of the year. We do project it will recover to around 2.5, 2.6% for the rest of the year and through 2019, largely as a result of that increase, that high consumer confidence, but also because of those higher pay packets as a result of those tax cuts. But on the other hand, if, as Joe says, consumers will assume a certain level of refunds next year and not actually receive those refunds, some of the whatever spending is generated over the next few quarters may come back once the realities of the tax bills are realized. In addition to that, when wage growth is a bit stronger and when there's more upward pressure on prices, we do see higher inflation numbers. Both the CPI and a measure that we often use to assess market inflation expectations, which is a 5-year nominal rate versus a 5-year inflation protected rate, both of those rates are right above the 2% Fed target line. That's going to mean somewhat higher interest rates going forward. You'll likely see 3 more Federal Reserve interest rate increases during the rest of the year and probably 3 more next year to get to a rate of nearly 3%. And that's going to filter through to other parts of the economy and make mortgages and firm borrowing more expensive. Now, an important thing to remember in terms of thinking about the economic outlook is that government spending, too, is going to rise substantially. And Joe, I just wanted to ask your opinion about how the new spending measures are going to impact the economy and also impact firm and mortgage behavior over the next few years.
Well, one of the problems that we face, Brian, is a certain amount of uncertainty looking forward with the stability of the federal government's revenue collections and of its spending. We started out at the beginning of last year with a budget outlook that was really unsustainable. We saw rising deficits, which accumulate into rising debt. The debt was growing faster than our collective income, our GDP. And that can't go on forever, especially given that after the financial crisis, the debt that the federal government is carrying continues to be substantial. Now, the picture that we're showing people right now is the change in the outlook that occurred since the beginning of last year because of both the higher tax cuts, the substantial tax cuts, and the higher spending that was negotiated between the president and the Congress. The president and many on his side of the aisle wanted higher defense spending. Democrats wanted higher domestic spending as an alternative or in addition. They compromised on both. And as a result, we started off with a tax cut that was initially estimated to cost us $1.5 trillion over 10 years. The spending deal that was cut at the end of last year, if you assume that it's a one-time thing, would plug into that debt an additional $600 or so billion. And you take all of that together, and as this chart shows, we have a higher debt, higher deficits running in the early part of the next decade. At that point, it looks like things get better. It's important for people to understand that that's not what is happening. There are some changes in the law, provisions of the law, tax cuts that are set to expire, that everybody who's sober in Washington believes will be made permanent eventually. It's going to be very hard to allow those tax cuts actually to expire. Beyond that, there is a provision on the corporate side where stranded income overseas is being repatriated back home on a compulsory basis, and firms are going to have to pay taxes on that repatriated income. That is front-loaded over this period of time, and as you go into later years, that revenue is going to disappear. So what you really see in this chart is, for about half of the decade, higher deficits accumulating more debt, and then a kind of a false dawn, which is really not going to happen, and those deficits are going to continue to grow beyond what we had anticipated up to this point. That means more pressure on the Federal Reserve because those higher deficits are going to threaten greater inflation. The higher interest rates that the Federal Reserve is probably going to have to impose are going to increase the cost of the federal government servicing its debt, which is going to increase the deficit even more. And as that process works its way through, there is going to be a threat to the higher spending levels, which we in our outlook are looking at providing some support for the economy in the short term. If there's constraint coming down the road on spending, that means on federal government spending, that means it's going to dampen consumer demand. And there's a very good chance that the short-term burst of economic activity that we're seeing because of the tax cuts and because of the higher government spending may have to be constrained not only by higher interest rates from the Federal Reserve, which are going to discourage home buying, automobile purchases, purchases of all sorts of durable goods that are typically bought on credit, but also because there's going to be constraint on the federal government's fiscal policy. That debt is going to somehow have to be covered. It's going to have to be serviced in the future. It's not serviced in the federal budget right now. It's not serviced in the baseline. We're going to have to make savings in the future, which are going to further constrain the impetus to consumer spending.
And I think that's a really important point, that these deficits are going to raise borrowing costs on a long-term basis. And one group they're going to have a profound effect on is home buyers. You can see in this chart that as the 10-year Treasury yield, which is right around 3% at this point, as it rises, so does that 30-year mortgage rate, because you can see that the green line, which shows the difference between those two rates, it remains fairly consistent. So the spread between those two rates does not change much over time. So bigger deficits, that means bigger borrowing costs for homeowners who are already faced, in many cases, with some unfavorable provisions from this tax law. At the high end, the mortgage interest deduction is capped, so it's less beneficial. So that's a reason why home prices may be a little less valuable. On the low end, because individual tax exemptions, standard deductions are higher, that's going to mean fewer homeowners are actually going to find it sensible to take their mortgage interest deduction. So in both cases, the balance moves from owning to renting. And when you combine that with higher interest rates, on the one hand, that does lead to some immediate increased demand simply to beat those higher interest rates, knowing that the Fed is likely to raise rates. Maybe some homeowners try to jump up their purchase dates so that they can finance at lower costs. But on the other hand, for some home buyers, that's going to ultimately dissuade them just because the costs are going to get too high. Right now, the construction market looks pretty strong from a residential perspective. We see steady growth since the recession in terms of permits, in terms of starts, in terms of median sales price. There are plenty of indicators from the construction sector suggesting that demand remains strong, but we're going to see as capital costs rise what effect that's going to have. I do want to just quickly, before we get to the corporate side of things, answer one question from the audience, which is an excellent question about whether the employment cost index is a leading indicator of wage growth. Generally, we do not interpret it that way as simply an alternative measure of wage growth. That was a very good observation that the ECI is indeed ticking up faster, but there's no particular reason to believe that the ECI rising will mean that the other measures will necessarily rise beyond the fact that it is a key and respected indicator of wage growth. So in that sense, it could provide a signal, but there's no reason to expect it to move faster. Moving on to corporate and investment behavior, we start off first with a audience poll question, and that question is, has your firm boosted investment in the US or plan more investment in 2018 based on changes to the tax law? Yes or no? Answers are coming in. So far, we have a very close race. It's about 40% and 60%. I'll allow for another 15 seconds or so for responses to come in. And with that, we're going to close. There was a very late surge towards the no side, and we end up at around 23% versus 77%. Joe, Ilaria, any surprises to that result?
I find this very interesting, but not too surprising, honestly, because the reform is very recent, and it was passed only at the end of the year, starting from this year. While investment plans are often made over a longer period of time, so it feels like for the reform to have an impact on the current investment, it's too late, so it's too early to see the impact on investment, I would say. So I think these numbers make sense.
Joe, I think this will be a good lead-in for your discussion of the corporate tax measures in general. So are you surprised by these results? And then what are the key provisions to watch out for?
Well, really not surprised. We have a growing economy. We do have investment that is relatively strong. The question of whether firms are going to invest more because of the tax cuts has to take into account, as we were mentioning a moment ago, in all likelihood, as these tax cuts come down the road, they may very well cause increases in interest rates, which increase the cost of capital at the same time that the tax cuts decrease it. We also have to be concerned, of course, that this is a very new law. There are a lot of provisions of it that are extremely complex. We're expecting guidance to come out of the Internal Revenue Service over the course of the year. It's going to be a long process. So for a lot of firms, they're really just trying to figure out what this tax law is going to be. And when you get down to the granular level and you look at one particular investment you can make, how is it going to be treated? That raises a lot of questions. We did talk earlier about some of the corporate provisions that, and they're really important. Among the big items is the reduction in the statutory corporate tax rate. One can argue about the difference between the rate that's written in the law and what corporations actually pay. It's worth keeping in mind that the statutory rate is what applies to an additional dollar of income recognized in the United States. And so for many firms where there is some opportunity through transfer pricing, through relocation of intangible capital, that marginal statutory rate can be extremely important. We have a temporary incentive to invest through expensing of 100% of the cost of physical investments. That's going to apply through 2022, after which it phases out. Spoiler alert, when you get to 2022 and you begin to see that provision going away, you should expect many businesses to argue that the scheduled expiration of that expensing provision is a tax increase, and they'll argue against it. They'll say that the economy is fragile at that time. We do not have a very good track record of allowing temporary corporate investment incentives to go away on schedule. That one might continue.
When you say physical capital, we're referring only to equipment, not structures, correct?
That's correct, and it's an important distinction. It does, by the way, have a subsidiary effect of requiring in the law reductions in the deductibility of interest, because expensing investment and then allowing deduction of the interest in effect provides a tax subsidy which could be manipulated to a considerable degree. So one of the complexities here, and one of the reasons why this provision may be seen in a slightly tinted light by businesses, is the fact that there is an associated reduction in the amount of interest that is deductible. We have a special tax exclusion deduction for pass-through businesses. It is very complex. There are different classes, two different classes of businesses. Firms are going to be arguing which one they're in. They're going to be doing some reincorporation to try to recharacterize their businesses so that more of the income will be subject to the deduction. At the end of the day, the point here is to try to increase investment in the United States, not just to increase the capacity to produce, but also, we hope, through new equipment, making improvements in our capital stock that will lead to greater productivity, which will increase wages, which will increase consumer incomes, and lead to a virtuous cycle. Just to note, we've been trying to achieve that kind of virtuous cycle through tax law changes for decades. It is very difficult to do. There are a lot of steps, a lot of links in that chain, and it is very hard to get that whole process to move in one direction and actually to achieve faster economic growth.
Now, one thing about those tax cuts for pass-throughs, that's not just going to affect corporations and their behavior. That's also going to affect how highly paid professionals, in some cases, choose to create a relationship with their employer, correct?
There is certainly an incentive if you can manage to take your labor and turn it from employment into a contractual arrangement where you are compensated as some kind of a consultant or some kind of a contractor. To the extent that individuals manage to do that, they will be able to take advantage of that pass-through deduction. The Internal Revenue Service, the Treasury Department, have stated up and down that they are not going to let that happen. It's going to be very interesting to see what occurs when the highest quality legal consultants and accountants go to work with highly compensated individuals and try to create consultant or contractor relationships between their clients and their clients' erstwhile employers.
And that's an example of a change that we're going to have to watch very carefully to see how it plays out over the next few years. But in terms of the administration goals, they're hoping that by boosting long-term investment levels, productivity will be increased. Of course, as Joe mentioned, more spending or less revenue coming into the federal government, that's going to result in higher interest rates and more hawkish fiscal policy from the monetary policy from the Federal Reserve. And in addition, the expensing provisions could result in an allocation of investment away from structures and R&D and towards equipment. What this chart shows is some work that two eminent economists, former head of the Council of Economic Advisors under President Obama, Jason Furman, and Harvard professor Robert Barrow did to see what would be the effect of the tax law on capital and labor ratios over the next 10 years. That is the amount of capital in each of these categories available per worker. And what they found was that while capital to labor ratios would increase in all three categories, they would increase most in capital equipment. And what that means is that if you think that spending the most money on capital equipment relative to R&D is going to generate more productivity growth, then this policy makes a lot of sense. If you think that spending more on R&D or on structures would have been more desirable, then perhaps this is a suboptimal allocation of capital. So that's one thing to think about, that it's not just going to mean more capital across the board, it's going to mean a change in the allocation of capital. So what have the early returns been in reaction to the new tax law? Well, we've seen that a key indicator of demand for investment in equipment, manufacturing shipments of non-defense capital goods, has slowed in terms of growth over the past few months. The level of growth remains relatively high. As I mentioned earlier, the ISM Manufacturing Composite Index, the key measure of business confidence, that has also fallen a bit. And so what we're anticipating over the next through 2019 is that equipment, the blue line, will grow at a faster rate than structures or intellectual property products, which includes R&D. During the first quarter, structures growth was particularly strong simply because that does include oil-related spending, and oil prices, of course, rose. But we think over the long term, the structure of the tax bill will drive more spending towards equipment. And finally, I think it's important to recognize that there are risks that could cause a delay in investment behavior. These tax law provisions will be in place for the next 5 years at minimum, as Joe suggests. In many cases, they will be in place a lot longer than statutes currently provide. What you can see in this chart is that technology stocks had been doing quite a bit better for a long time than the economy as a whole. But in March, they did tick down pretty rapidly. There has been some recovery, but still there are risks around how consumer data protection is going to be treated and how those business models are going to play out over the long term. So that's a risk that could potentially result in a delay. And also trade policy could, and what's happening with oil prices. So there are a lot of reasons right now, even though the overall outlook is strong, for firms maybe to hold off on investment for a few months and to watch how some of those risks play out. So that's pretty much all of the time we have. You can look at our forecast table in more detail at your leisure. The slides will, of course, be available on demand. Thank you so much for joining us. Thank you to Joe. Thank you to Ilaria. Next month, we'll be continuing on our Pushing the Limit series. It will be moving on up. Is inflation ready to rise? And we'll talk more about some of the dynamics possibly driving prices higher for the first time in quite a while. Here are some additional publications and resources that you can take a look at and some upcoming programs to please tune into. So for Brian Shaitkin in New York, this has been Economics Watch. Thank you all for joining us.